All right, we're getting ready for a show today. Got the music going, got the tunes going, get everything all ready to go. Got my notes with one word on them. One word on it. Confluence. What about the word confluence makes today so important? It sums up everything that happened in the market, in the world of finance. That's what we're going to talk about today. So stick around. We're going to have a good, quick, easy show today, and I'm looking forward to it. I'm going to tell you exactly what happened today, why the market was up, why the market went down, why it gave up the ghost. If you have any questions about what we're talking about now, investing, personal finance, you let me know. Ask me in the comments. I love hearing from you. I love answering your questions. If you're watching in the replay, same goes for you. And let's get on with it. All right. Thank you for joining me. This is the 4:30 post-market show. I do this every Monday through Thursday at 4:30 p.m. I love doing it. It's called Be the Boss of Your Money. That's the show. It's all about helping you become the boss of your money because it's very easy for your money to become the boss of you. We've got a couple of things to talk about. I see some of you out there. Thank you for joining me. Hit me up in the comments with your questions, whether right now in the live or in the replay. Welcome. I see Brett is out there. Brett, you gave me an angry face, a frown. I think you're maybe you're a little frowny because the market went down, and that's okay. I get it. You're a little frowny today, but we want to put on a happy face. Okay. Listen, the market can't be up every day. We've hit so many highs this year. I think if we were to just turn the machines off now, most investors would be pretty happy. Granted, there are an awful lot of stocks. The majority of stocks are not trading at highs. And so many stocks are down on the year. And so many people got caught up in certain frenzies, especially meme stocks. And now they're like, what the hell was I thinking buying that stock at 80 and now it's like 40 or something? I'm talking to you, AMC diamond holders, diamond hands folks. Okay. I want you to know, I really can't stand when I bump into this cable. I don't know what it is, but I just don't like bumping into it. I don't like that. So you diamond handers in AMC. So let's take a look at a couple of things. I'm going to tell you what's going on, what happened. Okay. Brett says, LOL, meant to smile. It's okay, buddy. You happen to be a very smiley, I think, naturally happy kind of guy. Oh, I saw Paul at the gym a few weeks ago, and I thought, I'd love to get together with Paul and Brett. Okay, so that would be very cool. And thanks for joining me, Brett. I really, really appreciate it. So we've got a few things to talk about. First thing I want to do is get rid of my email. That should not be open while I'm live streaming. And then we're going to take a look at the market, and we're going to show you screen 4. I'm going to pop myself up in the corner over here, and we're just going to blow this up a little so you could see it on your smartphone, because you're watching this on a smartphone. I know you're watching this on a smartphone, and that's cool. Okay. So the Dow was down just about 300 points. First, fairly decent down day in a while. We were down 700 points about 7 weeks ago, but that just kind of came and went, and we went back on to new highs. The thing about making new highs, it's been on a smaller and smaller number of stocks. It's those big mega cap stocks, Amazon, Apple, Microsoft, the same ones we talk about every day. They've been hitting highs. Most stocks have not. But when the Dow is down almost 300 points, that definitely gets my attention. What else? NASDAQ down a little bit less than 0.5%. S&P off just about 0.6%. So NASDAQ holding up the better of the three major averages. Gold back to a little over 1,800. Big whoop. That gold has been trading around 1,800, give or take $50 an ounce. Forever. It seems like it's been going on forever. Oil is finally back up to 70. The 10-year treasury, in spite of having better than expected numbers on the inflation front. You remember, if you recall, the last 2 weeks or so, people were expecting to see today's inflation figures come out for the CPI, Consumer Price Index, would be so high that it would knock the market down. Interest rates would fly higher. Treasuries would get killed. The exact opposite happened. Treasuries actually went up. Stocks got hurt a little bit in spite of better than expected news. We thought we'd get higher inflation. We didn't. The VIX was barely up, still under 19. That's this year, the VIX. By the way, you like the green cursor on the screen? I made it a big green cursor, so it's easy for you to follow along. What I've been saying is, if we see the VIX stand at 20, we rally. If we see the VIX at 20 or higher, we sink. I think the market's gearing up to see a jump over 20 on the VIX. The fact that long-term, the 10-year Treasury, you see that over here, the fact that that went down to 1.28 from the 1.3s, that would ordinarily be helpful, but people are really starting to worry that, wait a minute, if inflation is moderating, then that means the economy is not doing as well as we thought. That's why the NASDAQ held up better than the other major averages, because the NASDAQ is more tech heavy, and it's those tech heavy stocks, tech stocks, that had any positive performance today was from a couple of those mega tech stocks like Microsoft. Okay, so let's move down a little bit on this list. The Russell 2000 I follow, that was down 1.38%. The Russell 2K, I have a friend named Russell. When I told him about the Russell 2000 like 20-something years ago, he was like, oh, is that an index named after me? And I still remind him that he made that corny joke every time we speak. So the Russell 2000 down almost 1.4%. The Russell 2000, the significant thing about the Russell 2000 is that it follows small companies, small cap stocks, which are more sensitive to the U.S. economy, the domestic economy. They have a harder time borrowing. They are, they get so much of their earnings domestically, so they don't have that overseas ability. They don't have as many exports. So it's more sensitive to the domestic economy. So the fact that small caps were down, and they've been not doing well this year, it just is a constant reminder that the economy, it's not booming the way we thought it would. We can have inflation with a booming economy, but if we're having inflation now, and it seems like maybe the economy starting to feel like it's moderating. Now, I know a lot of this is because of the COVID Delta surge, the Delta, COVID, whatever. We have the surge, people start to shutter in, they stop going out, and that hurts the economy. It hurts supply chains globally. China had, they had one case in a port city, and they closed down an entire seaport. I mean, these are the kinds of things that are happening. So supply chain disruptions, et cetera. These are all reminders that we have still a long way to go to get out of the pandemic mess. So I showed you before my notes today. I just wrote one word. Okay. Confluence. Today is a confluence of a bunch of things. It's inflation moderating, which is actually not being, it's not being perceived as such a great thing. It's being perceived as, wait a minute, did the economy slow down? Is that it? Are we done with the great reopening trade? Because the reopening stocks, the industrials, the ones that I follow, have been getting knocked down a lot. Today, they just continue to get crushed. It's like every single day, the reopening stocks are just getting pounded and pounded and pounded. This is why I always say, don't make a choice between reopening stocks, industrials, energy, financials, or the work from home, stay at home stocks like screen stocks, the Apples, the Microsofts, the Amazons, the Nvidias of the world. You have to have both, okay, if you want to do it right, be diversified. I just have to say, diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I also want to say that we talk about the S&P 500, the Russell 2000. These are indexes. You cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference, and I do have to point that out. And you can do with that information what you want, whatever you want, whatever the heck you want. We're adults. You do take that information and, you could just tell me to stick it. Whatever I don't, whatever. I won't be insulted. Hey, Josh, good to see you, buddy. I haven't seen you for a while over here. So good to see you. Are we going to meet on September 24th? Josh and I are in the same networking group. I am on the fence about going to in-person events that are indoors, but I also want to live. It's just a lot going on. And I don't want to be judgy either. It's like, you don't want to wear a mask, you wear a mask. Yes. Josh says yes. So he's up for it. Okay. That's cool. So the confluence is this. We're talking about the Democrats raising taxes, one of the biggest tax increases, tax grabs, however you want to describe it, that we've ever seen. Should raise over $2 trillion over the next 10 years. It'll take the highest marginal rate from 37 to about 39.5%. It'll raise capital gains taxes a little bit. It'll raise the corporate tax from about 21 to about 25. There are a whole bunch of tax increases. One of the things that I'm worried about is it'll get rid of the backdoor Roth IRA, which is a strategy that we talk about a lot here, where you could put money into a non-deductible traditional IRA and immediately convert it to a Roth IRA. So that will probably go away. And it looks like the wash sale rule will be introduced for crypto. Now, just in case if you're not following with what I'm saying here, the wash sale rule, you usually think of it in terms of stocks. So if you buy, let's say you buy a stock, you buy Johnson & Johnson, just the first stock that comes to mind, and you buy it at 150 and it goes to 140 and you sell it, you take a loss, $10 per share. And then if you want to buy it back, you have to buy it back after 30 days. If you want to take that $10 loss in the stock, the $10 that you lost, if you want to write that off, you have to wait 10 days to buy the stock. I'm sorry, 30 days. You have to wait until 30 days passes to buy the stock, okay? To buy back the Johnson & Johnson. You could sell the Johnson & Johnson as a loss and let's say buy Pfizer or Merck or Bristol Myers, but you can't buy the same or substantially the same stock. If you sell one S&P 500 fund from Vanguard for a quick loss and you buy the S&P 500 fund from iShares, you are basically, and you buy it back right away, you're violating the wash sale rule basically because you're buying something that is substantially the same. The only difference might be a slight bit of the expense ratio. You can argue with me on that. Maybe you want to try that yourself. That's okay. I'm not an accountant, so you have to consult with your personal tax advisor. I'm not an attorney, so I don't give legal advice. I'm not your mama. I'm not your papa, but I will be happy to give you family advice. My wife and I have been married now over 29 years. We have 3 kids, and I've been in this industry for almost 32 years. So I know a thing or two. I've seen a thing or two. I've made my share of mistakes, and I've done my share of learning. Plus, I've seen a lot of other people make mistakes. So, it's all good. I share with you the benefit of those mistakes. So let's go on to talk about this confluence. So this Biden Democrat tax increase coming on the heels of the Fed tapering its bond purchases. So we're still getting stimulus in terms of the Federal Reserve buying bonds. And what that means is this: every month, the Fed has been buying $120 billion worth of bonds, 80 billion of treasuries, 40 billion of mortgage bonds, in order to keep long-term interest rates low and to keep money flowing through the banking system. Okay, keeping a lot of fresh water running through the pipes, as they say, keeping the plumbing going of the U.S. economy. But the Fed did that because it was an emergency almost a year ago with COVID, with the pandemic, with the economic shutdown, the recession. But we don't really need those emergency measures because the economy is doing better. And granted, we have this horrible COVID surge. So far, it's localized in a number of states, which definitely hits the economy, but it hasn't shown up yet in GDP, in economic stats, except for until today, where we saw a lower than expected inflation figure, which I believe is a direct result of the economy slowing a little quicker than people expected because of the Delta variant spread. And then we've got the tax increases. This is not a foregone conclusion that the taxes go up or how much they go up, but I think it's fair to say they are going up. And then you've got the Fed tapering, meaning reducing the amount of bonds it's buying every month. That's why we say tapering. I don't know why they chose the word tapering, but that's what we're going with. So it's those three things. I'll throw in a fourth, the concern that maybe corporate earnings have peaked or are a quarter away from peaking. You put those together, all coming to us at the same time. It's a little bit more than what investors could bear at this exact moment. Tomorrow's a new day. Tomorrow's a different day. But when we had what we thought was better than expected numbers on inflation today, lower than expected inflation, stock market shot up about 200 points in the Dow and then shot down 300. It seems that the stock market is finding more excuses to go down than go up. That is indicative of a correction, Yeah. Okay. So let's see what else we have. And people are worried that their profits might get flushed down the toilet. And that's causing selling pressure. And if the economy does accelerate and pick up, and I know a lot of market soothsayers are saying, no, I think the economy is going to pick up, so you don't have to worry about the stock market. I think the opposite. Every time I hear somebody say the economy is going to do much better, I worry about the stock market because it's the fact that the economy was doing poorly that gave lift to stocks, because the big mega cap tech stocks benefited, believe it or not, from the pandemic. So if those stocks go down because the economy is doing better, now we have to rely on airlines and bank stocks and chemical companies and energy companies. And every time we start to rely on those sectors, we just get another kick in the teeth. So that's where we are. Let's take a look at a couple of things. I'm going to let you go a little early today. The other big stories today is Social Security. Because of inflation, we'll probably see Social Security recipients should see about a maybe 6.1% rise in Social Security payments. This is something that we spoke about like 3 months ago, and I wrote all about it and posted it on Instagram. By the way, if you don't follow me there, I'm at Insta Mitch G on Instagram, and you can catch me all the time on LinkedIn. LinkedIn is my number one place to be on the internet. This is my digital home, is my LinkedIn account. Okay, my digital home. So I'm always on LinkedIn. You can find me there. And this is just into today's news. And there it goes. It's coming up. Social Security cost of living adjustments, possibly 6%. We've been talking about this for a long, long time. So I'm glad everybody else is on board with that, but that's all good. The next big thing is this that I want to show you. I'm going to pop this, blow it up a little bit. Okay. You see this over here? FOMC meeting. The next Fed meeting starts Tuesday the 21st, ends Wednesday the 22nd. So Wednesday the 22nd, around 2:15, 2:30, we'll hear what the Federal Reserve's judgment is about tapering its bond purchases and interest rates. What we expect it to say is we're getting closer to tapering, but not quite there. But we do think, as the market goes, and what I think is the Fed will start to taper its bond purchases, probably November or December. But there's really not much economic news until then. So we don't really have a lot to go by. And I just feel like it's, the market could be down as much from slow trading and light volume. We do have a big options expiration day coming up on Friday. So let's get that out of here. And we'll just take look at a few things. I want to go to my watch list and take a look at the meme stocks. The interesting thing is that meme stocks, okay, and if you don't know what the meme stocks are, these are the AMCs of the world, the, Clover, Bed Bath & Beyond, GameStop. These stocks have been taking a hit. And if you see this line, like over here for GameStop, 483, the high, the red line there, $6.43. If you bought it at 643 and the stock is 199, you have nothing to complain about. But by the time people heard about GameStop, the overwhelming majority of people in the stock paid way more than 643. But these stocks are just coming in, and I feel like some of the speculative froth coming out of the market is an indication that some of the energy is coming out of the market. And last thing we'll take a look at are the sectors, what really worked, what moved the market. Healthcare, technology were the best parts of the day, still down. Worst parts of the day, industrials, financials, and energy. That's a pretty negative, it's a negative statement on the economy because those are the sectors that should go up if the economy is getting better. And we'll take a look at the FANG stocks, FANG M stocks. And these are the stocks we talk about a lot here. So Apple had its big news conference today. They introduced the iPhone 13, some new bells and whistles. Is it enough to move the ball? Well, they still have the 12 Max. They've increased battery power across their entire lineup of phones, slightly better cameras in the 13s. They came out with a new lower cost iPad mini. The watch has a few updates. The watch is expected to compete with Peloton, for example, some health uses, exercise tracker uses for the watch, and that knocked down Peloton a little bit. I'm not really sure if I would consider the iPhone watch a competitor to Peloton and all the interactive goodness that comes with the full Peloton shebang. It's a really cool thing. I know I do not have a Peloton. I've tried it and it seems really cool. And I have friends who have Pelotons and they live for their Peloton. It's like a community of people. It's the blend of social media, bike riding, racing. It's a lot of fun. It's people love that way of exercising. Facebook was up, Google was up $4, pretty good. Microsoft up $2.80, just about at its high, and Nvidia continues to stay near its high as well. That's why the Nasdaq is holding up better than the other major averages. All right, so let's stop sharing the screen. So let's go. Keith is up here. Keith, Mitch, love your show and passion for educating. You, sir, are a machine. You are a machine. Thank you very much. And go check out Keith Wilson on LinkedIn. He and another one of our friends, Anthony Ruffalo, just put out some hysterical content. These guys have mastered the art. That's you, Keith, of teaching with humor. I mean, it's really an amazing thing. I wish I could do that. So that's my story. I'm sticking to it. I've got to take my dog to the vet. Wish me a happy Benjiversary. We just got this little puppy 4 weeks ago today. So it's our, the camera's focusing. It's our 4-week anniversary with our new puppy Benji. So I told my wife, happy 4-week Benjiversary, and we just love that dog. Okay, I will not be here Wednesday, and I will not be here Thursday. It's Yom Kippur. So my next live stream won't be until next Monday. So we'll see you then. Miss you. But hey, if you're on LinkedIn or Instagram or Facebook and we're connected, I'll see you over there in the meantime. Thanks. Talk to you soon. Bye.